Thank you for having me. Okay, so let me give the summary. Taking stock of 2025 overall, it may be contrarian, but I think growth was basically solid. I think the labor market is mostly steady despite low headline job growth. And at the very least, we stopped making progress on inflation. I know that some observers look at the same data and they think that that means the economy is teetering, and without more rapid action from the FOMC, it might even fall apart or deteriorate. But I haven't found that persuasive so far. And so today I wanted to make 4 points about the economy and the data and what that might mean for monetary policy. Before I do, now to the great relief of everyone else, I say that what I'm about to say are my own views, not those of my colleagues on the FOMC or anyone else in the Federal Reserve System. Okay, point 1. For all the talk about AI data centers, I believe that the main driver of growth in the economy over the last year has been solid, broad-based consumer spending. If you look at the second half of 2025, real consumption expenditures grew at nearly a 3% annualized rate. Yes, January looks like maybe it'd be a little softer, but some of that is from brutal weather. Fundamentally, I think the solid consumer remains the key strength of 2026. And that's a more traditional source of growth. And I believe that it was broad-based. Okay, so let's remember, it's hard for consumer spending to be as strong as what we've seen in 2025 without it being broad-based. The BLS releases the distributional accounts data, which goes from 2000 to 2023. In that distributional accounts, the bottom 90% of the income distribution is 75% of the spending in the economy. And that share barely changes over that entire 23-year period. The New York Fed, you probably know, recently published more updated, what they classify their economic heterogeneity statistics, and they show very similar things, that over the last 3 years, the cumulative real growth in spending for high versus low income groups has been pretty similar. The difference is only around 1 percentage point difference in growth cumulative over the last 3 years. Now, for sure, there are many households that are facing important economic challenges. I'm not meaning to minimize those challenges. My point is that at the broader macro level, it's been broad-based consumption growth that is not something that can be explained solely by outsized stock market gains going to the top 1% or the top 10%. There is a darkish cloud floating around here, which is that measures of consumer sentiment are depressed. And historically, that would be a warning sign of what was to come for spending. But I don't need to tell this crowd that the measures of sentiment as predictive variables for consumer spending, that relationship has all but broken down in recent years. And so, in fact, at Chicago Fed last year, we looked at, in various conventional forecasting models, how does adding various measures of consumer sentiment affect the errors in the forecasting models of consumer spending. And we found that adding these variables literally makes the spending projections worse. The mean square error gets bigger. So I don't want to over-index on sentiment measures. As long as actual consumer spending stays solid, I view that as a recipe for stability. Okay, point 2, let's think about AI capital investment. I believe that's not as big a driver of the economy as some have portrayed it to be. There's been a lot of discussion rooted in two pieces of evidence, I would say. One is that if you kind of cover up one eye and look at the non-AI related parts of the economy, they're barely growing. The other is that if you add up all of the capital investment on AI data centers, that adds up to a surprisingly large fraction of GDP growth. I feel like people are rooted in this because of maybe a fear that an AI bubble could pop and then we'd be left with nothing if a lot of our growth is coming from that. No, I just told you, I think that the main driver has been consumer spending. But let's just unpack these AI piece of evidence a little bit. First, you can't cover up one eye and look only at the non-AI parts of the economy and insinuate that that's how the economy would be doing if AI wasn't there, because the AI and the non-AI parts are competing directly against one another for a whole variety of factors of production. And if you go out and talk to people, you hear it. Land, electricians, computer chips, HVAC equipment, all manner of different inputs would be cheaper for the non-AI parts of the economy, and they would be doing better if the prices were not as elevated because of the high AI demand. And second, you can't, if you just add up the capital investment on AI data centers, you are going to overcount significantly what impact that's having on GDP growth. Yes, the investment for sure contributes to the GDP, but a large fraction of that investment are imported goods that you need to subtract from the GDP. So I give you the example, this recent paper that was put out by the economists at the Board of Governors. They estimated that AI investment in capital investment in data centers accounted for a little over 0.4 of a percentage point to GDP growth in 2025. But then they show that if you properly subtract out the imported component, the net impact of data center investment is cut by more than in half to less than 0.2 of a percentage point. So I'm not saying that there is no AI bubble to worry about. It may be a bubble. My point is just that I don't look at GDP growth in 2020. When I look at GDP growth in 2025, I do not think that the AI data centers or the AI economy is the primary driver of what happened with that growth. Okay, point 3. I believe that the job market has basically been steady. For sure, a sudden deterioration of the labor market that we often see at the beginning of recessions, that would change the policy calculation pretty quickly. And if for sure, we have experienced now an extended period with low aggregate job growth, that you could interpret that low job growth as a sign of a weak or a weakening labor market that in a business cycle sense is falling apart. But that, as I say, is not my take. Yes, there's low net job creation in 2025. And the first estimates were even ended up getting substantially revised down as the full data came in. But fundamentally, I do not think that says very much about how much labor market slack is there. I don't think that's a valid indicator of where we are in the business cycle. It's completely obvious that the crackdown on immigration has clearly affected population growth and labor supply, and that reduces significantly the break-even level of payroll job growth. Aggregate job creation at moments like that, when there are big question marks about population and labor supply, turns into one of the least helpful data series for understanding how much slack there is in the labor market. We learned that lesson the hard way, or maybe it's the easy way, in 23 and 24, when payroll job creation was stunningly high, but that was not a sign that the economy was overheating or that the labor market was especially tight. The unemployment rate was literally rising through much of the time when we were getting those big jobs numbers. The unemployment rate now, except for a couple of months of statistical pollution surrounding the government shutdown, has basically been steady for a year. In February of 2025, it was 4.2%. And now we're going to go into February 2026 at 4.3%. Our Chicago Fed labor market indicators, which I'll put in another plug, they're really good. We should pay attention to them. They combine real-time public and private data sources. It's continued to show general steadiness on flow rates and on the unemployment rate. We're going to get the model's forecast for February on the February unemployment rate on Thursday. But I think modest aggregate jobs numbers, they can't be far from the true break even at this point, or else the unemployment rate should have been rising. That's basically the definition of what is the break-even point. When the population and labor supply have question marks, just like they did in 23 and 24, we learned that the rate-based measures of the job market, like the unemployment rate, the vacancy rate, the layoff rate, the hiring rate, those are better indicators of labor market slack and where we are in the business cycle. And over the last year, most rate-based measures have shown steadiness. Okay, again, other than we got a little bit of the statistical pollution around when the government shutdown is. And the levels of those rates are mostly comparable to standard previous expansions. The one weakest component in the rates has been the hiring rate. It is definitely low, and that is normally a warning sign. But again, it's low, but it has been steady, relatively steady for a year and a half. And it's simultaneous with the layoff rate, as well as the new unemployment insurance claims, having also been extremely low for a year and a half, which is normally a positive sign. And I would just remind us again, low hiring with low firing is not a normal indicator of the business cycle. It is instead exactly the combination that you get when businesses face heightened uncertainty and unpredictability. And as we go through the 7th District and talk to businesses throughout the Midwest, we continue to hear a large component of what we continue to hear is about uncertainty. We're going to wait to see what happens. And those kind of question marks and the question marks surrounding the Supreme Court opinion on tariffs and deciding, well, where are things going to go next and where are they going to be in July, to me, makes it feel like this low hiring, low firing dynamic may just continue for a long time. Okay, so point 4 then, if you agree with my analysis that the real economy is basically steady, I think that puts the focus back on inflation in the near term for thinking about monetary policy decisions. I don't think that's a surprise given the last 5 years. The public never left. That's been absolutely front of mind to them. And the inflation rate is well above the 2% target, has been sitting there for almost 5 years now. Over the course of 2023, we made progress on inflation. Then over the course of 2024, we made progress on inflation. In 2025, that progress completely stalled. Core PCE inflation for the year is around 3%. If inflation is at 3%, it's not even obvious that our interest rate policy is restrictive at all. The real federal funds rate measured that way is pretty close or maybe even lower than the consensus view of the long run real R-star. And the real rate isn't even that much higher if you measure it against year ahead inflation forecasts. 3% inflation is not good enough. It's not what we promised. It's not the target. Stalling out at 3% is not a safe place to be for myriad reasons that we all know too well. We must make progress on inflation. Now, I think there have been some encouraging signs on the inflation front. In housing, for example, it's improved nicely and looks likely to continue. But there have been some warning signs too on the inflation side. Goods inflation, of course, went the wrong way in 2025. You got multiple studies showing that the U.S. has absorbed the vast bulk of the cost of tariffs. But the question of how much has already found its way downstream or how much more is to come, we do not yet know. The optimistic case, of course, is that most of the increase in inflation on the goods side came from tariffs, and that most of the tariff inflation has already passed through. And if so, then the inflation should be transitory. And if the Supreme Court decision ends up leading to lower overall tariff rates, either way, we should be back on path to target inflation in the near term on the goods side. It's not just about goods inflation, though. If you take PCE core services, not including housing, that's been stubbornly high. That's 3.3% over the last year. That's very unlikely to have been coming from tariffs. It's harder to make the optimistic case that high services inflation is just going to be transitory. So I remain vigilant on that point, but optimistic. Like I say, I remain optimistic that there can be more rate cuts, plural, this year, but it hinges on actually seeing progress on inflation that shows we're on a path back to 2%. The forecasters, many of you in this room, have been projecting that we will soon see that progress on inflation in the near term. Goods inflation, particularly, is supposed to start fading. We have been burned by assuming transitory inflation before. And I view that there are certainly at least plausible scenarios where inflation again proves more persistent than we've been forecasting. And that's why I want us to be careful not to put ourselves in a bad position. The fact that over the last several months, the date at which the forecasters are saying inflation will peak out and start falling keeps getting pushed back from Q4 2025 to Q1 2026, now to Q2 2026. That is not a great sign. That is what happened the last time. So that's why I feel front-loading the rate cuts is not prudent. In every economic survey that we've looked at, and in all the meetings that we have with businesses and consumers across the 7th District, people express that prices and affordability and cost are among their most pressing concerns. So let's pay attention before we keep cutting rates to stimulate the economy. Let's just make sure inflation's headed back to 2%. Okay, so that's basically my overall view, that growth in the labor market don't seem especially fragile. There's a nagging bit of inflation that I'm hoping and expecting will subside soon. And once it does, it's going to allow us to get back on the golden path. I will close by just saying, in recent years, we've faced many unexpected, even unprecedented shocks. So there's no doubt in my mind that even besides giant snowstorms, 2026 probably got a few surprises up its sleeve. It's worth remembering at a time like this that I always say the Chicago Fed motto is there's no bad weather, only bad clothing. We're going to keep at it. It's easier to have that position when, if this were last week when Chicago was 61 degrees, but we will keep at it anyway. Okay,
Thank you. I'm not texting with friends while you're speaking. I actually have the questions on my phone. I just wanted to be clear. Oh, okay. Thank you. I had this as a backup. Okay. Lots of great questions coming in. And I think because you started out hot and heavy on the consumer, I think clearly a lot of questions came in right away on that. I think you started out with the points on sort of the distribution of spending.
Yeah.
But how do you view sort of, we've been talking about the K-shaped economy or the K-shaped consumer. Does that suggest that you have less of a belief in the K-shaped consumer if the distribution of spending has been pretty even?
I think maybe, I mean, it depends how you define the K-shape, but the implication of the K-shaped economy is only the top 1% or maybe the top 10% are driving everything. And that is being driven by the stock market, that it's back to the AI bubble. The stock market is way up. And so only the people who hold stocks are driving everything in the economy. I think that's overstated. As I say, if you look at the consumer spending numbers, that's not true. There clearly has been some wealth effect. But the main thing is you can't have consumer spending overall growing at a 3% rate, or I shouldn't say you can't. It's hard to have consumer spending overall growing at a 3% rate without that being spread beyond just the 1%. And I think the data shows that.
Have you taken a look at the recent savings rate data? Because if consumption is holding up, but the savings rate has fallen, is that worrisome in terms of how are we funding that spending?
Yes, and I mean you certainly don't want to over-index on a quarterly savings rate changes by 1%. As I say, there may be an AI bubble. My point is just if the job market is steady, in a way, the steadiness of consumer spending is an indirect indicator that the job market has been steadier than maybe some folks portray. Because if people think they're going to lose their job, the savings rate usually goes up. They start building up a buffer stock of precautionary savings. So the fact that, if anything, the savings rate is ticking down a little bit, to me is not a sign that they think that the job market's falling apart.
Okay. I'm going to come back to some more questions on the consumer because there were a lot that have come in. But I want to turn to inflation first. So you talked about the various metrics of inflation and also the tariffs, the inflation from tariffs will recede. Let's just say we assume.
That's what I want.
That's what I want. That's what you want. Okay. We all want that. So if consumption is solid and steady, is there a concern that services inflation could rise again as tariff inflation recedes?
Yes, and that's the biggest warning flag in the price data that we've been getting is this services component. That can't be high because of tariffs. If it might partly be related to labor supply, but that is historically, as you know, very persistent. Services inflation, very persistent. So if we keep getting readings that say services ex housing are not improving or going the wrong way, that would be a bad sign for the fight against inflation.
And so that's what you would watch for there. I mean,
Yeah.
can we pick apart the services inflation a little bit? I mean, don't we all have our favorite measures of this excluding that and the other, et cetera, et cetera? What would be sort of an indicator specifically or sliced a certain way that you would be watching for?
I'm tempted to say market-based. The market-based services are, I think, a little better, but I want to caveat that by my team. When I was saying that, and then my team went and looked and said, what's the better indicator of core services inflation? Just looking at the market or taking the whole thing? And they told me that taking all core services is a better measure, that it's not especially more predictive using market-based. I got to dig into that a little more. Inherently, I want to say the market-based ones feel like they would be more accurate, so keep an eye on those. Just in terms of shares, of course, healthcare is the biggest of the services that's going to matter for overall inflation, because it's just such a big part of the economy.
Yeah, and I know that for many households this year, the jump in healthcare expenditures has been quite pronounced, and maybe we just don't quite see it in the data yet.
Yeah.
Certainly that sucks the air out of the room or out of your wallet in terms of other things that you can spend on. What about the tax refund season that's coming? When people get extra money in their pocket, you might be a little less price sensitive for a time. If we were to see some sort of pressures and inflation at that time, would you be more apt to be patient and look through that?
I think you would if you could invent any data, see through the true data. I kind of think that's describing just a normal increase in demand, right? We're gonna hand some income, demand's gonna go up, that puts price pressure. That's just a regular business cycle that lasts for 3 months. So mostly I think you would want to look through that.
Okay. I want to get to some labor market questions too. You gave a plug for your wonderful Chicago Fed measure of the labor market.
Write that down. Ellen Zentner said wonderful. Let's put that on.
Wonderful,
like
yeah.
The book reviews, on the bed.
But you see, there's always a downside after I say wonderful. So here's the downside.
Look at the time. We're done.
Do you think it's better than, say, something like Neela Richardson's measures at ADP? Neela, who's right here in front of you, with a sample size of 28 million. What do you think?
Well, it's different. It's different. What we're making a forecast of the unemployment rate, and so far since we came out with this, we've been doing extremely well in what that real-time forecast is, so we're using flow-based measures, and we use a lot of the private sector sources. So I'm not going to in any way denigrate the private sector sources. They're critically important. We want to know what's the hiring rate of the unemployed and what's the layoff or other separations rate of people with jobs. Okay, so those are the three factors that it adds up, and I think it's pretty good. It's not trying to estimate what the jobs number is going to be. It's rooted in these rates, and at moments like this, I think those rates are, I find, a better way to think where we are in the business cycle and the amount of labor market slack.
So the unemployment rate is the best measure of slack. Would you agree? I mean, it's been refuted
It's a
at
great
times,
measure
but
of
it's a
slack.
great,
Yeah.
okay, a great. We don't need to say best. We'll say
Yeah.
great measure of slack. But so is wage growth. And if you look at a slew of measures of wage growth, they've been decelerating over the past year. Could that suggest that the break-even rate being so low is less a factor of supply and more a factor of just less demand?
Maybe the only thing, when we get into the realm of wage growth, I just want to caution everybody, remember, wages are stickier than prices. And so when I first started in the Fed in 2023, there was a lot of discussion about inflation can't come down because wage growth is too high. And I said at the time, whoa, wait, be careful. Remember, shock hits, prices go up, then wages go up, then prices come down, then wages come down. So absolutely, inflation can come down before wage growth comes down. In the long run, they got to be consistent, but that doesn't tell you anything in the short run. And I kind of feel that, and that is what happened. Inflation came down a lot even before the wage growth came down. And now just be careful not to make that same, is it a dynamic error? It's not to make that same error of timing today. So there are some people saying there can't be an increase in inflation. Where would the increase in inflation come from? Wage growth is still modest, under control. Okay, if a new shock is hitting, where it's going to happen, the first thing that's going to happen is prices are going to go up and wages are not going to move yet. And after the prices go up, then you're going to see the people come back and say, wait a minute, I need a wage increase for what just happened. And then we'll start the whole discussion, is this a wage price spiral, et cetera. So wage growth, real-time nature, I'm a little skeptical of using real-time wage growth as an indicator of where we are in slack in the labor market.
Okay. I wanted to go to something that I thought would be great for the folks in the room to hear. And it was, I'm pretty sure it was 2023. It was after the big run up in inflation in 2022. We were at the Monetary Policy Forum, which must have been in 2023, after that big run up. And you were marching around with a big piece of wood in your hands, and you were wielding it, and we were like, oh, like it was one of the 10 commandments come down from above. What was that?
It is. It almost is.
Because now I've piqued everybody's interest. Why am I carrying around wood at a conference?
I was very close with Paul Volcker, as Ellen said. I was kind of his chief of staff, and he was a friend and mentor and really personal hero to me. And I was the most annoying young person. I was asking him, well, what was it like in 1979? And why did you do this? And when he died, his widow gave me the original 2x4 that they sent him. You heard that the construction sent him 2x4s, to protest. And he kept the first one, and it's a piece of wood, and it's scribbled on the front. It says, please lower these insane interest rates. And I keep that in my office, and as I say, to remind me of Paul, but also what the Fed does matters to the economy. It's not just it's not an intellectual game. And sometimes it's the Fed who has to do the hardest job. Nobody else wants to do it. And so the Fed has to do it. And that was the thing I carried around. You said I was wielding it?
You were wielding it.
I felt I was more.
There was like an aura around it.
But there was, and
we were all gathered around.
There is that aura.
Yeah. Well, I would be remiss if I didn't ask you a question that someone had had expressed they'd really love to know this question, know the answer to this question.
Yeah.
You ready for it?
Yeah.
Has being a part of the Federal Reserve System now beat the funny out of you? Like, I don't think so. I think based on today, we have you lost your sense of humor? Have you lost your sense of humor? I don't think so.
No, look, you know, there's a 5-year lag in the transcripts. But when the transcripts come out, I think you'll be relatively pleasantly surprised that about how much funny remains at the FOMC.
Okay, that's great. That's good to know.
Yeah.
Thank you so much for giving us your time this morning.
Ellen, it's great to see you again. Thank you guys for that.